After studying this module, we shall be able to distinguish between cash holding and fund. Understand intra-firm flow of funds. We also would be able to understand the risk in internal financing and learn about management of receivables. An international firm requires funds not only to finance fixed assets but also for current assets in order to maintain operations of the business. A firm uses various sources of funds to finance current assets. Firstly, the firm should determine whether or not it has sufficient availability of internal funds before resorting to external financing. Intra-firm flow of funds is very common among multinational firms. Through this method, a firm can utilize internal financing by requesting a transfer of funds from one of its subsidiaries. When a firm operates internationally, it has to face various constraints in transfer of funds from various units of the same firm. For example, a firm faces foreign exchange risk when the exchange rate changes as the value of cash inflow and outflow or value of exports and imports gets affected. Also, it faces political risk when restrictions are imposed on the flow of cash or inventory by the government of host and home country. There are many options available to the international firm which facilitates transfer of funds in the presence of strict exchange control, such as transfer pricing, parallel loans, leads and lags, changes in dividend payout ratio, changes in the rates of royalty and other fees, and use of blocked funds. What are the motives for holding cash? The most liquid form of asset is cash. It includes demand deposits and currency. Although cash is an idle and non-earning asset, but minimum amount of cash is required to be kept in order to maintain liquidity in the business. Transaction motive refers to the requirement of cash to meet the need of day-to-day business activities. A firm holds cash to make payment for cash purchases, payment of salary, wages, rent, tax, insurance, etc. At the same time, it receives cash in the form of sales and other incomes. If cash inflow and outflow were of equal size and simultaneous, then there is no need to hold cash. But in reality, the size of cash inflow and outflow is not always equal. And also, there is a time gap between the inflow and outflow of cash. This makes the holding of cash essential for the firm. Precautionary motive. Precautionary motive refers to the requirements of cash to meet the unexpected occurrences or contingencies that may arise. If the firm has a sufficient cash balance, then it would be able to face the unexpected events or accidents. For example, if a customer does not pay the bills or the raw material supplier do not provide credit, then the requirement of cash will appear immediately without prior notice. A firm keeps cash in the form of near cash assets which can be converted into cash easily whenever emergencies arise. The third motive for holding cash is known as speculative motive. Speculative motive refers to the requirement of cash to exploit profitable opportunities that may arise any time. For example, a company may find an opportunity to purchase the raw material in large quantity before the beginning of inflation in a country. Sometimes it may also get an opportunity to acquire another company on beneficial terms if it has sufficient balance of cash and cash equivalent assets. For this purpose, cash is held in the form of near cash assets. The cash holding of an international firm is also influenced by intra-firm and inter-firm flow of funds. There are many constraints that influence both the flows. Exchange control mechanism adopted by various governments considerably influence these flows. A single multinational firm cannot solely control the inter-firm cash flows, and hence its maneuverability is very limited in this respect. On the other hand, an MNC can control the intra-firm cash flow, and hence its maneuverability is quite large. The parent firm can impact the intra-firm flow of cash even if there is an exchange control, and thus can manage the requirement of cash of all its subsidiaries. Intra-firm flow of funds. Let us try to understand the direction of flow. Intra-firm flow of funds can take place in three directions. These are namely from parent to subsidiary. Major component of the funds moves from parents to its subsidiary at the time of setting up of project in the host country. The supplementary cash flow takes place in the form of investment in working capital and for transfer pricing. The second flow could be from subsidiary to parent. The flow of funds from subsidiary to parent takes place in the form of payment of dividend, royalty, and technical service fees, disinvestment by the parent company, interest and amortization payments on loan given by parent company, proceeds of export, import payment, and also for transfer pricing. The third kind of a flow could be from one subsidiary to another subsidiary. Fund moves from one subsidiary to another subsidiary in the form of proceeds of export, payment for import, and transfer of funds for meeting cash need as authorized by the parent. Form of transfer of funds. In the presence of exchange control mechanism, an MNC may choose any of the following method to transfer the cash from one subsidiary to another subsidiary. First is transfer pricing. Transfer pricing is the pricing of transactions that occurs between different units of the same firm. When goods, especially intermediate goods, are moved from one affiliate to another, then the price of such sale take the form of transfer pricing. In intra-firm transaction, prices are generally charged above or below the arm's length prices. Arm's length prices are those prices that are charged in transactions between unrelated parties engaged in the same trade under similar conditions in the open market. Transfer prices should be set keeping in mind the arm's length prices. It depends upon the maximization of benefits that the two subsidiaries will get and the overall maximization of profit that the parent unit will get. If the maximization of centralized profit is the main objective of the firm, then the profit before tax of the subsidiary located in high tax country is shifted to another subsidiary located in a low tax country. Such transfer of profit is known as money transfer prices. On the other hand, if maximization of aggregate net output is the objective of the parent company, then the price of intermediate goods should be designed in such a way that it helps in boosting up the production multiplier so as to facilitate production in different subsidiaries. Such type of price designing is known as efficient transfer prices. Thus, the main difference between money transfer prices and efficient transfer prices is that the objective of the former is to maximize centralized profit and the latter is to maximize the net output. Parallel loans. Parallel loan is also known as back-to-back loan. In this method, two parent companies take loans from their respective banks and then lend these amounts to the subsidiary of other company. Suppose a subsidiary of a US parent company is located in India. At the same time, a subsidiary of Indian parent company is located in US. Further, suppose that US parent company has to lend $2,000 to its subsidiary, and also Indian parent company has to lend similar amount to its subsidiary in US. If it is expected that exchange rate will change, both companies will lend the same amount to each other's subsidiary. In this case, Indian parent will lend the amount in rupees to the US subsidiary and US parent will lend the amount in dollar to Indian subsidiary. On the maturity, both subsidiaries will repay the amount to their respective lenders. Figure 1 shows how the funds move under back-to-back loan agreement. Leads and lags. Leading means reducing the number of days of credit, while lagging means increasing or extending the number of days of credit. If the period of credit is shortened, then there is larger flow of cash from purchaser or importer to the seller or exporter. On the other hand, if the period of credit is extended, then there is flow of cash from exporter to importer. Suppose there are two subsidiaries, X and Y. Subsidiary X regularly supplies raw material to Y, let's say worth $4 million a month on 90 days credit. The average size of receivables will be $12 million. If Y has to transfer the cash of $8 million to X, there will be leading of the terms of credit to 30 days. On the other hand, if X transfers $12 million to Y, term of credit will be lagged to 180 days. In this case, there will be flow of cash of $12 million from X to Y during the 3-month period, and also size of receivables will move up to $24 million. When there is strict exchange control, this method is widely used by the firms as governments are less likely to interfere with the payment terms. However, benefits from this method cannot be considered in isolation of the lending and borrowing rate. When the credit period is shortened because of leading, the importer is required to pay more in that particular time period. In order to pay the exporter, it borrows from the market. On the other hand, exporter earns a particular rate of return by investing that amount in short-term marketable securities. The benefit of leading will be achieved only when the rate of return on investment is higher than the rate of interest on borrowing. Changes in the rates of royalty and other fees. Royalty is a sum paid by a subsidiary to its parent for the use of company's name or special processes, usually under a license or licensing arrangement. Fee is a compensation for the services of the professional and expertise supplied by the parent to subsidiary. Whenever an MC is set up, there is an agreement between the parent and its subsidiary by which the rate of royalty and other fees is fixed. The parent company can make changes in these rates for the purpose of transfer of liquidity. If the subsidiary has cash surplus, then parent company will increase the rate of royalty and other fee. On the other hand, if subsidiary faces cash deficit, then parent company will lower the rate of royalty and other fees. This will help the subsidiary to maintain the required cash. However, changes in the dividend payout ratio. Dividend remittance is a very common method to transfer the excess funds from subsidiary to the parent. Dividend policy is influenced by the political risk, tax factor, foreign exchange risk, and other factors. If dividend payout ratio is higher, the subsidiary would be able to transfer the excess funds to the parent company. Reverse flow takes place in case dividend payout ratio is lower. In order to achieve the uniformity in dividend payout ratio with that of the parent company, the deviation in this ratio should not be large. A company can make changes in dividend payout ratio for the purpose of transfer of liquidity, but it depends to a large extent on the cost of alternative sources of funds. If the borrowing cost is less than the opportunity cost of the cash balance in the host country, then dividend payout ratio will be higher. Again, changes in this ratio depend upon the difference between tax rate on retained earnings and the tax rate on dividend payout. If the tax rate on retained earnings is higher, the parent company will raise the dividend payout ratio. But the strict control by the host government on the flow of dividend comes in the way of this practice. Some firms do not allow abrupt changes in dividend payout ratio as they enjoy the idea of stability in dividend. Use of blocked funds. Sometimes the government of host country may block the transfer of funds by subsidiary to the parent. In some countries, it is required for the subsidiary to reinvest their earnings locally for at least 3 years before they could be transferred to the parent. A parent company adopts a number of techniques in order to use the amount of blocked funds either in that host country itself or in any other country. They are as follows. Transfer pricing. Transfer pricing is used in such a way that it will result in increasing the expenses made by subsidiary. The government of host country is generally more relaxed on transferring of funds sent to cover up expenses than on earning remitted to the parent. Leading and lagging. When there is a strict exchange control, this method is widely used by the firms as governments are less likely to interfere with the payment terms. However, benefits from this method cannot be considered in isolation of the lending and borrowing rate. The benefits of leading will be achieved only when the rate of return on investment is higher than the rate of interest on borrowing. Use of fronting loans. Fronting loan is a loan provided by parent to its affiliate channeled through a financial intermediary or a bank. Suppose an Indian subsidiary in US has blocked funds, but due to the presence of strict exchange control mechanism in US, it could not transfer the fund in India. The Indian parent would prefer to use a fronting loan and will deposit that amount in an international bank that has its office in US. The bank will then lend that amount to Indian subsidiary in US. It is the bank which front for the parent. When the specified period gets elapsed, the subsidiary repays the amount to the bank, which in turn passed on to the parent. Generally, banks are interested in fronting of loan because of two reasons. First, the banks do not face any risk because it has 100% collateral. The second is the interest on loan received by bank is higher than the interest paid by banks on deposits. The figure 2 shows the technique of fronting of loan used by parent for the use of blocked funds. Creation of unrelated exports. This is another method used by firms for the use of blocked funds. In this method, subsidiary whose funds have been blocked creates additional exports. For this, additional amount of investment is required that will come out of the blocked funds. Barter deal can be used for additional exports in which Indian subsidiary in US export those items that are not in demand abroad. Sometimes, in order to utilize blocked funds, parent may ask a subsidiary to set up research and development activities which incurs cost and also help in generation of revenue for other subsidiaries. Forced reinvestment. This method is used in case the blockage is temporary. In this situation, the most obvious alternative is to invest the amount of blocked funds in the money market of the host country where a number of instruments are available with different returns and maturities. In case money market is not well developed or illiquid, the parent may ask a subsidiary to invest the blocked funds in good industries. If this alternative is not available, then funds can be invested in acquiring an asset whose value rises with an increase in inflation rate. Management of receivables. For an international firm, it is very stressful to manage trade receivables, handle credit risk, and satisfy the ever-increasing demands for service from the market and the growing business. Thus, it is very crucial for international firms to have every possible advantage so that it can give them an edge to grow, differentiate, and thrive. Receivables are the current assets and represents money owed to a firm by a customer for goods and services provided on credit. Generally, a firm maintains or invests in receivables in order to face competition and to increase sales and profits. When a firm sold goods on credit, it leads to emergence of account receivables. There are twin objectives of management of receivables. First is the cost of receivables should not exceed the benefits of receivables, and second, whether the sale is intra-firm sale or it is an inter-firm sale. Benefits and costs of receivables. Let us try to understand first the benefits of receivables. Many firms sell goods on credit as it offers many advantages. These are as follows. The first advantage is increase in sales. A firm is able to sell more goods on credit than sales on immediate payment. It is because of the reason that customers get more time to pay for the goods if payments are postponed. The second advantage is increased profits. It is expected that when the sales of the firm increases, then profits also increase. A firm through its credit sales can increase the volume of sales and also earns a higher margin of profit. The third reason could be facing competition. Sometimes firms give credit facilities to its customers in order to protect its current sales against emerging competition. Hence, the motive is the retention of sales. Let us now understand the cost of receivables. Benefits from receivables represent only one side of the coin. A firm cannot continue increasing the size of credit sales as funds get locked in account receivables. In order to meet the need of its operational activities, firm requires additional funds, which would involve extra cost in the form of interest. Also, the chances of bad debts increase with increase in receivables. Thus, investment in receivables is beneficial as well as dangerous for the firm. The various costs associated with the account receivables are: so financing cost is when the firm sells goods on credit, the process of receiving cash gets delayed, and this results in blocking of financial resources. Consequently, the need for additional funds arises to maintain the level of production and sales. Additional funds can be raised from outsiders or out of retained earnings. In both the cases, a cost is incurred, that is, interest cost in the former case and opportunity cost in the latter case. Administrative cost. In maintaining the account receivables, a firm is required to incur some additional administrative cost that includes cost of employment of personnel, maintaining records, investigation of customer creditworthiness, etc. The second cost is the collection cost. A firm incurs additional cost in order to collect payment from their credit customers, especially in case of delay in payment. Such cost increases with the growing size of receivables. Another cost is the defaulting cost. Sometimes firms are not able to realize their sale proceeds from the defaulting customers in spite of best efforts. This will increase the chances of bad debt losses. If the firm follows liberal credit policy, then the losses on account of bad debts will be greater. Another kind of loss is foreign exchange losses. If during the period of credit exchange rate fluctuates against the exporter, then this will result in foreign exchange loss. Thus, the appropriate policy for the firm related to management of receivables is that it should expend credit up to a point where marginal cost of receivables is equal to the marginal benefit on increased sales. If the volume of credit sale is less than the optimal size, then benefits shall be less than the maximum. On the other hand, if the volume of credit sale is more than the optimal size, then costs will be higher to slash the benefit. Selecting an optimal term of credit. The costs and benefits of the receivables are influenced by the terms of the credit given to the buyers. If the terms of the credit are liberal, the benefits will be larger, but at the same time, cost will also increase. On the other hand, if credit terms are stringent, then both the costs and the benefits will be lower. So, it is necessary for the firm to determine the optimal credit terms that gives maximum net benefits. For this, a pro forma of income statement is prepared by the firm to find out net profit by assuming a particular size of sales and the size of different costs. The term that gives the maximum net profit is selected by the firm as optimal term of credit. Credit policy. A firm credit policy is a kind of trade-off between the benefit of receivables in the form of increased sales and profits and the cost of receivables in the form of blocking of funds, losses on account of bad debts, etc. In a competitive market, a firm credit policy is always influenced by the credit policy followed by the other firms in an industry. Suppose a firm changes its credit policy by extending the credit period of 90 days, whereas other firms in the industry extending a credit period of 30 days. Now, this will increase the demand for the firm goods. Further, other firms will have to reduce the credit period in the long run. It is generally assumed that such factors have already been considered while making changes in the credit policy of the firm. Intra-firm sales. In case of intra-firm sales, the emphasis of management of receivables is on the global allocation of funds rather than timing of payment or on the quantum of sale on credit. The size of receivables is very large due to the vertical integration of different units situated in different countries. In vertical integration, different components of the same product are manufactured in different units and exported to the assembling units. In intra-firm sales, purchaser and seller both belong to the same firm. Thus, it hardly matters whether the payment is made early or late. If the subsidiary is suffering from shortage of cash, it can delay the payment. On the other hand, if the subsidiary has surplus of cash, then the payment will be quick. Sometimes, in order to adjust the credit terms, firms frequently use leads and lags. A subsidiary should make hasty payment if it is located in a weak currency country so that cost of receivables borne by the firm as a whole may not be large. A couple of decisions are taken in case of sales to an outsider firm or inter-firm sales. These are currency denomination and terms of payment. As regards currency denomination, exporter would like to denominate the transaction in the currency that is stronger, while the importer would like to denominate in a currency that is weaker. However, if the exporter has debt in weak currency, then it may like to denominate the transaction in weak currency even for long-term credit. By doing so, exporter will be able to retire the debt through the proceeds of sales without any loss on account of changes in exchange rate. As regards the payment terms, if exporter denominates the transaction in a weak currency, then it does not grant longer period of credit and tries to get proceeds of the exports as early as possible. An exporter provides liberal terms of credit if it is able to borrow from the bank on the basis of receivables and not on the basis of actual inventory. Again, if there is tough competition in the market, then exporter allows liberal term of credit. It is because tough competition forced the exporter to finance a part of the importer's inventory, and this act increases the sale of the firm significantly. Students, let us now summarize what we have learned in this module. We have learned that a firm holds cash for transaction motive, for precautionary motive, and for speculative motive. In an international firm, cash holding is influenced by the intra-firm and inter-firm flow of funds. These flows are influenced by the exchange control mechanism adopted by various governments. Intra-firm flow of funds takes place in three directions: from parent to subsidiary, from subsidiary to parent, and from one subsidiary to another subsidiary. We have also learned that international firm uses various methods to transfer the funds in the presence of strict exchange control, such as transfer pricing, parallel loans, leads and lags, changes in the rates of royalty and other fees, changes in dividend payout ratio, and use of blocked funds. We have learned that transfer pricing is the pricing of intermediate goods that move between different units of the same firm. You have also learned how parallel loan is a technique in which two parent companies take loans from their respective bank and then lend these amounts to each other's subsidiary. We have also seen how leading means reducing the number of days of credit and lagging means extending the number of days of credit. We also had moved on and learned that a parent company can make changes in the rate of royalty and other fees, and also in dividend payout ratio for the purpose of transfer of the liquidity. We have also learned how to use the amount of blocked funds. The parent company adopt various methods such as transfer pricing, leading and lagging, use of fronting loans, creation of unrelated exports and forced investment, and learned that costs that are associated with the account receivables include financing cost, administrative cost, collection cost, defaulting cost, and foreign exchange loss. We have also learned how in the case of intra-firm sales, the emphasis of management of receivables is on the global allocation of funds rather than timing of payment or on the quantum of sale on credit. We have in the end learned how intra-firm credit sale takes care of currency of denomination and terms of payment.